Everyone, this is John Peterson here live with Washington WREIA in the month of May 2021. I hope everyone is doing well. Tonight, I'm kind of flying solo. I do not have any technical support in the background, so hopefully everyone can hear me and we can have a good meeting tonight. If you want to check in with me, that would be appreciated, just to make sure that everything is going okay here and that folks out there in Zoom land or StreamYard land or however you're tuning in tonight, knowing that at least some of this messaging is getting through. Jim, thank you. I appreciate you checking in, just to know that there's someone out there listening. We are live on Facebook. We are live on YouTube. So feel free to check in as you tune in and we go live here. As I said, I don't have any technical support tonight, so I'm a little bit nervous that we could have a few issues and I would be done. Tonight we are going to be kind of diving into a subject that's a little bit different than what we usually talk about. Washington WREIA has definitely focused on the last 20 plus years on everything to do about real estate, really kind of catering, if you will, to that kind of mom and pop real estate investor, as I've been for the past 20 plus years, talking about different subjects, talking about wholesaling, talking about finding good deals, talking about raising private capital, talking about self-directed IRAs, and all the other subjects that kind of surround residential real estate investment. We dive into a little bit in commercial real estate at times. We sometimes have speakers come in, as some of you know. But tonight we're going to be tackling a subject that has just been in the news nonstop. So that's why I thought it'd be kind of an interesting subject to kind of go back and forth with. Now, generally, so you know, a little behind the scenes, when I prepare for Washington WREIA meetings, or I'm invited to do other meetings across the country to other WREIAs, or do a radio interview, I try to prepare quite a bit. I try to have way too much information. So if we're going to be talking for 30 or 40 minutes, whatever the case may be, I have plenty of information and I can kind of go to the well, if you will. Tonight, I don't have quite as much information. I'm really relying on you guys, hopefully, to ask some insightful questions. If you have any interest in this subject, anything that you want to add, be more than happy to bring you in here and answer your questions if I can, or to pose those questions certainly to the audience on inflation. So again, giving people a little time to kind of check in. A little bit different screen for me tonight. As I said, I don't have behind the scenes, so I'm trying to juggle a few things. So I'm going to give everyone a few minutes to join in. I hope everyone is doing well. Hard to believe that we're already in May. We've been coming to you kind of through this virtual landscape now for the past, let's see, 14 months or so, I guess. It really is hard to believe. It does seem like things, and I'm sure you'll agree, that things are opening up. People are getting vaccinated. The acceleration in the economy feels like it's happening a little bit. What I mean by that, it seems like things are moving along a little bit more. Deal flow maybe is increasing a little bit. People are getting out a little bit more. There seems to be a few more opportunities out there. So I hope you're feeling that too. And as I said, if you're just tuning in, you can see some of you here on the screen. Certainly, if you want to check in, feel free, just so I know that you're out there. You can say anything you want on your check-in. Hello, goodbye. I'm from Manassas, I'm from Alexandria, and I'm from Potomac, wherever you might be tuning in here tonight. So, Washington WREIA. As I said, I'm just going to kind of open up with that. We've been at this now for a lot of years, and the reason that I'm tackling this subject tonight on inflation is really because there's just been so much in the news about it. There's been so many different articles, so many different blog posts, so many different interviews that I thought it might be interesting to just kind of talk about a little bit, just kind of talk through it, define it, talk about how it kind of happens in our economy. And then more importantly, toward the latter part of tonight, really want to talk about some things maybe that you can do about it. Now, I want to start out by saying that, listen, the best economists in the world, the smartest men, women in the room, they try to predict these things. If I learned anything over the years, I learned anything in the last, major recession, I guess in 2008, 2009, is that nobody really knows. Nobody really knows what the future holds. There's so many things that kind of go into this, that a lot of this is just our best guess. I'm going to give you my 2 cents. It's probably not worth even 2 cents, to tell you the truth, because a lot of it seems to be unknown, where we don't really know what's going to happen because things are always happening. We live in a dynamic world, is all you know, and it's really hard to predict. But we do our best. We do our best to kind of look at the data. We look at the analyze it and take a look. The reason I kind of geek out on some of this stuff, I was an economics major way back now. And I enjoy reading about some of these things and trying to position my business in some way to hopefully take advantage of things happening in the economy and also protect some of the things that are happening in the economy. But it's not a perfect world, and sometimes it's very difficult to figure out what's going on. Nancy, I appreciate it. Yes, lighting my face a little. I apologize. I'm in this new office, and I haven't quite figured that out yet. So you're just going to have to bear with me a little bit there and just kind of listen to my voice. And I don't disagree with you. I need a little more light here in this office. All right. Let's kind of dive in. Steve, thanks for joining me. Good to see you. Let's see, Jim, Tanya, Janice, very good. Thank you, Janice, for tuning in. All right. So let's kind of just start out tonight. Again, if you have any questions, feel free to throw them up on the screen. As I said, I'm juggling a bunch of different things tonight because I have no one behind the scenes. My cohort, Justin, is off tonight. He's got some business things that he's dealing with. So we kind of try to set this up and try to do this where we didn't have much help. So I apologize if any little snafus happen tonight. All right, inflation. Let's talk about it here. And this subject does affect us, folks, whether we know it or not. A lot of us kind of go through our businesses where we just kind of react to things, and we're very reactionary. We don't kind of plan forward. And I think if we step back and take a little bit of time and understand some of these concepts, that we can kind of position ourselves in some ways to take advantage of some of these things. But generally, inflation, a lot of you know this, a very broad definition is just an increase in prices that happens over time. And it erodes our purchasing power, right? I mean, things go up in value, all right? And that almighty dollar that we all earn has less purchasing power. I mean, that's a very simple definition of it. We're going to talk about some examples. I'm sure if you want to chime in on some of the things that you're seeing in your own business, I'm going to let you know definitely some things in my business that are just very stark, that are happening in real time right now. I'm receiving every day about inflation happening. And then, as I said, as we walk through this, we're going to give you some ideas on maybe what you can do, and then kind of a little bit of a prediction at the end of this presentation. All right. So rising prices in goods and services, okay, in the economy. And really, this can happen. I mean, inflation can happen if there's some kind of disruption. And I think we all kind of can understand right now what the disruption has been. And that's really the debate in the economic community, if you will, is this pandemic. I mean, they are comparing our inflationary numbers now in the months of March and April, where they've really spiked, to a time last year, obviously, when the whole world stopped. And so the real question is whether or not this inflationary pressure, this prices on goods and services, is a reaction to that pandemic, or do we have a real systematic issue here that we all need to be very worried about? And just kind of as we start this, inflation is not as big a worry as something else that can happen here. A little bit of inflation is fine. A little bit of inflation does not really erode our economy too much. What we're really afraid of, or what I'm afraid of, to be honest with you, is stagflation. And we haven't seen stagflation in this country for many, many years. I mean, the last really kind of episode of stagflation, I'll define that here in a minute, was kind of in the early 70s under President Nixon. And that is where inflation is happening. Okay, so it keeps inflating, prices keep going up. And then on the opposite side, our wages do not increase or decrease, and the demand for goods and services declines. So now all of a sudden we're in this period of economy where prices are going up and nobody wants to buy anything. And that's going to be a real problem. And if you're in business, or if you're a consumer, that those can be some really tough years. So our hope is that it doesn't get out of control and we kind of walk into this period of stagflation. A lot of economists don't believe that's going to happen, but like I said, everybody is somewhat guessing on that. So that's really, in my mind, what we're really worried about. On inflation too, when you think about it, I had a nephew that just graduated from college and he got his first job. He had an economics degree and he got his first job, and his first offer was $34,000. Now, $34,000 isn't a lot of money, but it's his first job. He's out of college. He's got to start, earning some money, and he took this job, which is fine. He's working very hard at it. And I'm sure he will get promoted or find another job, and his wages over time will increase. But when you think about inflation, my wife, and I won't date her too much, but she graduated from college in late 80s, let's say early 90s, so I don't date her too much. And her first job out of college at that time was $32,000 a year. So think about that. I mean, she was making $32,000, let's say in 1990, when rents for an apartment were $800, $900, $1,000. My nephew Chad, who's making $34,000 a year in his first job at age 22 or so, what are rents in Reston and in Herndon, in the area that he lives in? I mean, they're a couple $1,000s, $2,200, $2,300, $2,400. So the rent has inflated up that high, but his actual wage hasn't increased that much. So clearly that is a lower level of living. His living standard is much lower than when my wife graduated from college and could afford an apartment, could afford some things. So inflation is that increase in price over time. And if our wages don't increase to offset that, our standard of living goes way, way down, way, way down. So how do we measure this? How do we measure inflation? Well, there's something called the Consumer Price Index. And I know some of this for some of you is incredibly boring. I get it. But again, it's interesting to understand, or it's important to understand some of these things. Tonight isn't about how to wholesale your first house, or how to buy your first rental, or how to finance your deals. We cover all those things, and we will continue to cover all those things. And if anybody ever wants to reach out to me, I'm more than happy to spend time with you to talk about those things. Tonight, though, we're talking about a very narrow subject that's in the news everywhere. So how do we measure inflation? Well, it's basically something called the Consumer Price Index. And Consumer Price Index, all that is just the basket of goods and services used by consumers that economists measure over time. And so they look at how much those basket of goods and services have increased in price over time. Now, something that's interesting and a little frustrating about economics and inflation and some of this talk is there's also something where they exclude food and energy. Okay, so in that Consumer Price Index, they take away food and energy. Why do they do that? Well, they say they do that because those two goods and services, food, all sorts of kinds of food, obviously, and energy, those prices fluctuate wildly. So they take those out and they come up with what they call a core inflation index. All right, a core inflation index. And again, when certain parts of the economy expand, or certain areas of economy have these wild price increases, that Consumer Price Index can be skewed a little bit. And again, the debate is that because we're in this great pandemic, and as we all awake, kind of like the cicadas, we're all coming up and coming out, and our demand for goods has increased. Inflation, again, is partly because we're demanding these goods, and there's so many people chasing so few goods that the producers are allowed to raise those prices. Is that the reason for inflation? Or are there other reasons, underlying factors, that are going to cause us to get a little bit out of control? We'll talk about that here in a minute. So you really got to take a look at those core inflation numbers. And like I said, in April of this year, they went up like I think they said early 4.2% or so. And in March, it was 3.6%. So they're on the rise versus a year ago where those numbers were much, much lower. So we have to be kind of cognizant of this CPI and kind of figure out where some of this is going. The reason that we look at inflation and how we can prevent it is very, very simple. I mean, they can put a stop to inflation by, again, this is us as real estate investors, would affect us greatly, is if the Fed started not buying bonds and so forth, and they raise those interest rates. and they kind of slow the economy down, that would put a little bit of dent in inflation. See, this inflation is caused by all this money flowing into the economy. I think we can all agree. All this government stimulus, all this unemployment, all this child tax credit, all these incentives, no evictions. I mean, all these incentives, there's rent relief. All this money is being poured into the economy. And again, we're not here to talk about politics, whether you agree with that or disagree with that. But all of that is being pushed into the economy, and that money is chasing fewer goods because of some of the things that went on with the pandemic. I mean, things like used cars, for example. Used cars have spiked, they said, literally 14 to 15% in the last 2 months. Why is that? Well, simply because the car companies last year, there was no demand. Nobody was traveling. So they sold off all their fleets. In fact, Hertz, I'm sure a lot of you read, went into bankruptcy. So when they sold all those cars, now as people are coming out and they're getting ready to travel again and they want to rent cars, the car companies don't have the inventory. So there's all these people chasing a limited supply of rental cars. Therefore, those things are going up. And the rental car companies are buying as many used cars, as many cars in production as they possibly can. So it's a simple supply and demand issue. I don't know if you've looked at renting a car recently. We're looking at planning a summer trip. We were looking to go up kind of in the northwest part of the country, kind of going into eastern Washington, kind of traveling up to Glacier National Park. It seems like half the country's going up that way, but we enjoy that part of the country, up through Montana, northern Idaho, stop at a few different lakes, and just kind of do a little road trip up there. And when we looked at the car rental, renting the car for 7 to 8, 9 days costs as much as flying out there on an airplane. So it's a tremendous, upshoot in the price of car rental. Now, will that kind of, balance out over the next few months? Maybe, maybe not. I mean, my guess is it probably will. As there more production of cars, as demand and supply kind of even out, some of that I think will kind of go away. Okay. Some other things, and again, chime in if you've seen things in your business. I just got a letter from my carpet supplier. I use Classic Carpets in Jessup, Maryland. Great guy, Terry. I've used him for 20 years, and he just sent me a letter telling me as of June 1st, all of his costs are going to be raised by 6%. Well, again, he's got to, his costs are going up. I'm sure his cost of carpet that he's buying from his wholesalers, I'm sure their raw materials are going up. They're passing it on to Terry. Terry's passing it on to the consumer. Just like the home builders. I know all of you have heard lumber's gone up 300%. How is that possible? I mean, they're saying the average cost of lumber on a new home has gone up literally $36,000. Well, the builder is just passing that cost on to the consumer. So if you want to buy a house now, a new house, it's going to be $36,000 more than if you bought it, let's say last year or then 2019. So this is passed on along the economy, and the end result is us as consumers, if we decide to purchase at this time, we're going to be paying more. And if our wages don't go up, that could be a real, problem in the economy. Right now, it seems like people are paying some of these prices. So used cars, lumber's going up, building materials like my carpet, my appliances, all these things are raising in price. And as a renovator, as someone that fixes up houses, this affects our bottom line. We'll talk about that here in a little while. Supply chain issues. I mean, I'm sure anybody that's been in the real estate business in the last year has run into supply chain, or if you're a consumer, go try to buy, a package of Samsung appliances even 2 months ago. I mean, sometimes the wait for some of these things where I used to be able to buy them and have them delivered in 3 days to maybe 5 days max. Now, in some cases, it can take 6 weeks, 2 months. Some cases, particular refrigerators could take 3 or 4 months. Finding windows, just replacement windows. We bought a house in December, end of December. I immediately put in the window order because I heard this was coming. It took me 2.5 months to get my windows, where usually it took me a week. This is all because all these factories around the world shut down. They shut down because they had no demand. They couldn't afford to run the factories. But now as the economy's opened up and people have the demand for these products, it takes a while for get all this back in the supply chain. And in the meantime, everyone is raising their prices a little bit because of supply and demand. And the question is this supply chain kind of gets back in order, will some of those prices either level or even come down maybe a little bit, depending again on supply and demand. So all of these things affect us. I'm not sure if they're tuned in tonight, but I had a couple that has come to WREIA, and they were out looking for a very kind of expensive RV, and an RV recreational vehicle that they were going to use, the particular model they wanted, was selling for about $110,000. Very expensive in my mind, but not to RV people. But literally because of supply and demand, if they wanted this thing delivered and they had to wait 6 months for it, they were going to have to pay $150,000 for this vehicle. Now, they decided to do it because they were ready to do it. They were ready to enjoy this part of their life. They wanted to start. They didn't want to wait. They didn't want to see what would happen to the prices. And they went ahead and put their order in, and they received this vehicle. So all of that is supply chain issues. And the argument and the discussion is whether that will all play out. But this affects us. This affects us as consumers, and it certainly affects us as real estate investors. Again, if you have any questions for me or scenarios, certainly chime in, and I'd be happy to answer some of those things. So, and used cars, lumber, semiconductors, global chip shortage. We've all heard of that. Reduced the production of new cars. All these things got so skewed in the last year. So the big question is, are we coming out of this pandemic? Are we coming out and everyone's kind of coming back to life, and the demand in certain industries is going to grow tremendously over the next year, in the travel and entertainment and venue rentals and weddings and birthday parties and all these things. And people want to buy new homes, and they want to buy new cars, and they're tired of sitting in their houses. They're like, life is too short, and we want to travel to Europe, and we want to go on vacation in the US, and all these things. Is that the reason prices are going up? Or is it because the federal government has just flooded this system? And a lot of people have been talking about this for a number of years, keep flooding this system. And at the same time, okay, inflation is created by monetary money coming into a system like we've seen, and at the same time constricting growth. How do you constrict growth? Well, they have policies that kind of reduce supply, like raising taxes. I mean, are we seeing that? Yes, we're seeing the administration talk about some of these things. More regulations. Does that, kind of halt a little bit production and business? Yes. So if you have these two things combined, is that going to take us into an area of inflation and maybe eventually stagflation? Again, that's the debate. That's the debate. And that's what we have to kind of think about as we go through. All right, let's talk about a few kind of positions or solutions, or how we can kind of position ourselves, if that's the correct word. Number one, we all work for what we call dollars, right? For salaries or commissions or profits, or we trade our skills and our talents and our labor, if you will, for dollars, right? Folks, dollars are not wealth. It's just made up. It's just made up value, right? We trade our dollars, our things that we work hard for, and someone returns. If I flip a house and someone gives me, hey, here's $15,000, John, for your efforts, I take that $15,000 and I exchange that $15,000 for stuff, right? Wealth, believe it or not, is stuff. It's not dollars. It's stuff. Now, I guess people could argue, once you get into the Bill Gates worlds or the Elon Musk worlds, if you have enough dollars, you are wealthy. But still, again, they exchange those dollars for stuff, and that's where their real wealth is, right? Jeff Bezos' wealth is his ability to have created Amazon. I mean, Amazon is supply chain and his cloud computing and his government contracts, all that stuff, all those contacts, all his talents. That is where his real wealth is. But for us as regular folks, right, these dollars are what I call, and I've read this a number of places, are basically claim tickets, right? We're exchanging that dollar for stuff. Now, this is the real differentiator. People that understand inflation, understand wealth, and that people that continue to be in a treadmill and work, exchange their dollars for stuff and exchange their dollars for stuff and never get ahead. And they look back and go, gosh, that was a lot of work and I made a lot of money, but what do I have? That's because they're trading their dollars for stuff that has value. Let me define that. When I was an economics major, I only remember a few things from college. Shoot, I was typical college student. I, studied some and played a lot of other, did a lot of other things. But I do remember some of my professors. And I do remember some of the little things they taught me. And one of the things they taught me early, and I remember this to this day, is that when we have money to trade for stuff, we have a choice to either invest in guns or we have a choice to invest in butter. And what I'm talking about here is we need to learn how to invest in guns. And I don't mean actual guns, obviously. I mean things that have value, like income producing real estate, like commodities, like stocks, growth stocks, things that have value, things that grow in value. Appreciating assets are guns. Now, butter, which the vast majority of consumers invest in, is just stuff, is just bigger TVs, fancy cars, the latest fashions, the latest clothes, fancy dinners all the time. I mean, butter is just depreciating assets, things that don't hold or grow in value. All right. And that's an important thing to understand, because if you live below your means, and you take that extra money and you start investing in guns, appreciating assets, some of these things you don't have to worry about. You don't have to worry about as much inflation as we're going to continue this talk. You want to position yourself where you're investing in these guns, okay? Because see, what happens is that a lot of folks right now are receiving dollars. They're receiving their claim tickets, but they're not producing anything. I mean, and when the vast majority of people are receiving, handouts, let's, call it what it is, and they're not producing anything, at some point, that treadmill's not going to work anymore. And with all this government stimulus and just flooding the market, we got to be very, very careful. We have a tremendous labor supply issue right now too. Now, again, there's so much debate about this, and I'm not smart enough to tell you why. All I know is there's a labor shortage. My son, who's 17, went up to Rockville Pike, okay, and knocked on a few doors, and a restaurant owner, a fast food casual, they call it, right? On the spot, no application. Luke's got no experience in a restaurant, offered him $13.57 per hour to work as a cashier. And then as he started, asked him, does he have any friends that can also come in? Folks, about 4 or 5 years ago, my older son, Jack, could not buy a job on Rockville Pike. He had friends knocking on 30, 40, 50 doors to not get any jobs. So we have a labor supply issue. Now, is that because of the pandemic? I'm sure partly. People maybe are afraid to go back to work. People maybe can't go back to work because they don't have anywhere for their children, if childcare is very expensive or those things aren't open. I mean, all that is valid. And there are a percentage of people that are receiving benefits from the government that decide, hey, I'm making as much or more than if I worked, and I choose not to work now. And that when this runs out, I'll go back and go into the labor force. And that could be a small percentage. So who knows why? The problem is we have a labor supply issue on some of these entry-level jobs, which is pushing up some of these wages, okay, that can also fuel some of this inflation. Therefore, that burger joint, right, that Luke is working at, if they're paying him $13.60 an hour, clearly you're not buying a hamburger for $4 or $5 anymore. I mean, the tab there, Luke said, when he checks people out, it's running $18 and $19 per person. That's expensive for, fast casual food. But that's what the owner of that business has to charge. He has to pass it on to us as consumers in order to make his business viable. So all these things are kind of going, working together, if you will. All right. But it's a problem. It's a real problem if we continue this this monetary policy of keep spending and keep spending and keep spending. Again, Republicans and Democrats, they both spend, 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 spend. And, some of those folks receiving some of these benefits aren't producing anything. You get less and less people producing. That's going to lead to quite a bit of inflation. So how can we combat this? How can we make sure that we are in a position where we thrive here and don't die? All right, and don't die. Number one is, as I said, simple economic concepts, folks. Again, I've had a birthday recently, and I'm looking back. I'm reflecting a lot right now. I guess I am getting older, but I'm looking back. What did I do well in my career? What have I done poorly? And folks, I've made a ton of mistakes. I mean, the amount of money I've lost in the real estate business is staggering to me sometimes. Now, I've made a lot of money too, and hopefully at the end of the day, the amount I've made is more than the amount I've lost, and life goes on. That's been the case, but I made a lot of mistakes, and I look at some of those mistakes and try to figure out what could I have done differently, and also what do I want to accomplish going forward. But one thing that I've done right, and one thing that I encourage all of you to do, is you need to invest for the long term. Wholesaling real estate, flipping houses. Like, I've been buying, renovating houses for 20 plus years, 25 years now. Okay, buying and selling mortgages. All these things are fantastic, but the real wealth, right? The real wealth is holding long-term assets, guns, holding appreciating assets over time is where the real wealth is. And I've done that pretty well over time. Certainly there's things I wish I could have held. Certainly I look back and I think, man, that $130,000 Capitol Hill townhouse that I did, I wish I held. It'd be worth $800,000 today, or $1 million, or whatever the case may be. Man, that note that I sold short, I should have just held on to it. Man, those investors that we got out of this deal, we should have held on to it. I mean, there's countless opportunities that I wish I would have done differently. But one thing that I really encourage you, if you're tuning in here tonight, and if you're new to real estate or you're not new to real estate, look at your business and figure out how you can hold on to appreciating assets over time, and you'll be very happy. Because let me give you some examples here of what goes on with inflation, and this will kind of prove this point. And we all, if you have a grandparent, you've heard them say, man, I remember back in 1965, we used to go to the movies for $1, and now they're $15. Well, folks, they're just talking about inflation. They're just talking about when they bought a candy bar for a nickel and now it's $1.79. That's just inflation. That's inflation. As long as wages grow, that's fine. But you'll see over the past 30 years, and I give you the example of my nephew, the wages haven't really kept up with price increasing. That's why we have an affordable housing issue in my mind. I mean, it's very difficult. There's so many different reasons. I go so many different ways, but it's very difficult to afford a house that keeps appreciating if you're making X amount of dollars and you're not getting wage increase. If you're not getting raises every single year to keep up with inflation and outpacing inflation, you're going to fall behind. Even if you're making $34,000 today and $50,000 in 10 years, man, if inflation kicks in, you're going to be way behind. So number one, we have to invest in guns. Let me just give you an example. Let's say we do 5 projects next year. All right. I'm going to give you some scenarios here. We sell each of the houses for $300,000. We buy them each for $180,000. So we're buying them value. We're putting about $50,000 in renovation, right? Good numbers. Buy $180,000, put $50,000 in, sell it for $300,000. Probably have about $30,000 in auxiliary costs of closing the house, buying and selling, paying an agent to sell it. We have holding costs. We have utilities. I'm putting a round number about $30,000 there. So our profit is $40,000. Okay, 40 times 5, $200,000 of revenue for the year. Not too bad. You pay your expenses, you have a decent income. Okay, and you can go up from there. Next year, inflation kicks in. All right, inflation kicks in. We do the same amount of houses. We do 5. All right, but now because of inflation, all right, our houses are now worth $320,000. All right, so we have a $20,000 spread there that we didn't have this year. Good thing. But remember, our costs are always also going to go up. So now the sellers have found out, and this is happening right now in our marketplace. The sellers now understand that, man, the real estate market's good. My house is worth more. My house isn't worth $300,000 or $290,000 or more. It's worth $320,000, $330,000. I demand a higher price for that, even if the house needs work. So now we have to pay $195,000 for that house, right? Because the media is pushing it. Everyone's saying, hey, the market's good, the market's good. Plus, the other thing that goes up is our costs, right? Our renovation costs go up. I just told you I'm going to pay 6% more for my on my carpeting next year. I'm going to pay for more for appliances. I'm going to pay more for paint. I'm going to pay more for my workers, my labor. Folks, my labor has gone up tremendously. It's very hard to find good contractors now at affordable price. You really have to work at it. So now all of a sudden my costs go up to $35,000, not 30 anymore. So I paid $15,000 more for the house. My costs have gone up $5,000. Now my profit all of a sudden, after you do the math, is only $33,000 per house. So next year, I only make roughly $165,000, not $200,000. All right. So even though the housing price has gone up, everything else has gone up, and my bottom line has gone down. So you got to be very, very careful as we go into this inflationary period. If this holds, and watch these numbers that come out to the government. If inflation takes hold, okay, you got to be careful or understand that your profits going forward could be a little lower unless you adjust. Now, what are some of the things that we can adjust if we're renovating houses? Now, if you're wholesaling a house, no big deal. You take your money. Now I've got $10,000. You might make a little less. I have $10,000. Now you have that claim tickets, and you're exchanging that $10,000 for other goods and services. Not going to buy you as much as it did last year because things are more expensive. Okay, things are more expensive, but you're still surviving. You're still working. Some of the things that I suggest you do, certainly if you're renovating houses or if you're a landlord and you're renting homes, if there's any sales you see and you can stock up on supplies now, if you can buy at today's prices, you might want to. Maybe you see a sale on hot water heaters. Maybe you see a sale on appliances. Maybe you see a good price on some paint products that you use the same color every single year. Maybe you invest in a storage facility right now to stock up on a few supplies. So a lot of those things you can do to offset maybe some of these cost increases. All right. Maybe you do one more deal next year. Maybe instead of doing 5 deals next year, you got to do 6 deals to make up for some of that lost profit. That's kind of how I look at some things. Say, you know what, I got to make up some of this inflationary period by maybe doing a few more deals, or maybe not. Maybe I just reduce some of my living expenses to offset some of that. Okay. Now the hedge for inflation, as we've talked about, is very, very simple. You need appreciating assets. You have to outpace inflation with your assets, not your income. It's going to be very hard to do unless you have an income that's structured where you can make bonuses or you can make more income next year. So if you're in a fixed income, if you have a salary, if you make $58,000 a year this year, and next year you make $58,000 because you don't get a cost of living bump, as they say, CPI index bump of 3% or 4% or whatever it might be, your purchasing power is going to go on. You're getting poor. Okay, I'm free to tell you that you're getting poor because you can't purchase as much if we have this inflation sets in. Now, if you can make bonuses, if you can do a side hustle, if you can do something to offset some of that loss, you're in good shape. But the real hedge against inflation is, as I said, living below your means and investing that in inflation-proof investments like income-producing real estate. One of the best, because that asset is going to keep pace, in theory, with inflation. It's going to grow every single year in value over time. Now, it might be fits and spurts. It might be 1 or 2% one year. It might be 6, 7% 2 or 3 years out. But over time, historically, real estate has been a tremendous hedge against inflation. Growth stocks, things that grow in value over time, can be a hedge. Believe it or not, being a borrower is a great hedge against inflation. If I own a property and my fixed interest rate is 3%, right? And my property's worth $300,000. In 2 years, it's worth $350,000. Now, because of inflation, appreciation. Now, I still only owe that 3%. I still only owe, let's say, that $200,000, but my asset is growing. So now I can use that money if I sell to pay off that debt. I'm getting ahead in theory. That borrower, that lender, his money's stuck. His money's stuck at 3%. And if the economy is growing that much faster, that money is not working very hard for him as a lender. So lenders in fixed instruments, in fixed interest rates, are actually losing in the game of inflation. So you got to think about that. What's some other investments that make sense in inflation? Like I said, growth stocks, anything that grows faster than inflation grows. Now, if we get into a stagflation, if we get inflation out of control, like in the 70s and early 80s, when rates were, inflation could be 13% a year, you better have assets that are growing to keep up with that. Even if you lose a little purchasing power over the course of a couple of years, it's okay. If you have the right investments over time, you're going to be staying up. You're going to keeping up with the Joneses, if you will, from your investment standpoint. Other things like mortgages, if you can buy discounted mortgages and create a 11, 12, 13, 18% return on your capital, inflation would have to really rear its ugly head in order for that to be a bad investment. And if we do get into that period, if interest rates go through the roof, and folks, through the roof in my mind right now is 8, 9, 10%. We haven't seen that for many, many, many years. Look at the housing market. If rates went to 8%, it would crater overnight. It would stop in its tracks. So if you are in the middle of renovations right now or going forward, just be aware of that. Understand that if you can't sell that house, it'll happen overnight. It will. It'll all of a sudden it'll just be stopped. And if you can't sell that house, be in a position to be able to rent it. So you might look at renovations or investments that there's multiple exit strategies. These are some of the things you can kind of think about. I have 6 renovations going right now. We're about to buy about 3 more. So we got our hands full here, and we'll continue to buy this year. But as I go through the year, all these investments I'm buying right now have the ability to be rented, and rented at a level where I can sustain mortgages, where I can sustain a period of a couple of years of high inflation, because I believe that could be coming. Now, the other side of me believes it's a supply chain issue. I probably lean toward that a little bit. I believe that once everything gets back online, I think some of this demand is false. I don't think the economy is as great as everyone thinks, meaning that I think we're just coming all out and we're all ready to celebrate and party, a little bit like the Roaring 20s. Not the same, because we had World War II back in the 1900s and people were really ready to party. But we are ready to spend a little bit of money. We're ready to go back out to eat. We're ready to have some family celebrations. I know a lot of us are ready to travel. Get on planes, go see things, go to games. I went to a Nationals game the other day. Felt great. Was with some friends in a little dinner party. Felt great. We're ready to do some of those things. So demand is going to increase. And if supply chain is holding that back, those things got to come into balance. But I think as we go through this year, if you see that creeping, that CPI creeping up, you might want to protect yourself. And as you buy some investments, make sure that you have multiple exit strategies. Okay. But the main point of this is buy guns, buy appreciating assets, hedge yourself against inflation. Understand it's real and it can happen. Sometimes I think we feel protected because we haven't seen some of these things in a while. But if it rears its ugly head, be prepared also to get educated on creative real estate. I mean, if we have interest rates getting up into 9, 10, 11, 12, 13%, folks, it's going to be harder for people to get mortgages. We're going to have to do some more creative real estate. So maybe bone up on some things that you can do there. It'll be some great opportunity to buy some mortgages. It's going to be great opportunity to own or finance some properties. Going to be great opportunity for private investors to come back in. So there's a lot of things that we still can do in an inflationary period as real estate investors. We just have to prepare ourselves and just kind of keep our eyes open and our ears open to what's going on. Read those articles that come across your stream. Try to get you educated on just some basic verbiage of inflation. That's what I try to do a little bit tonight. I don't think I've done a great job, quite honestly, but I tried. It's kind of a difficult subject here in this kind of format to hopefully get through with some of you. So I hope some of that was helpful. Any questions? I see some people up on the screen here. If anybody has any questions or ideas or anything maybe that you're doing in order to prepare for inflation, or anything that you've seen in your own businesses. I know my young son, I laugh and learn a lot from him. He came home the other day and he owns a car. We helped him buy a car, actually an old car of mine. He is responsible for putting gas in it and so forth. He came home complaining. He said that it cost him $40 to fill up his car, and a couple of weeks earlier, it only cost $30. And so he's figured out that now he's got to work 3 hours to get a full tank of gas. And he cracked me up because he was going out the other night and a friend came by and picked him up, which is a little odd. And I said, why'd that happen? He goes, well, I want him to spend his own money on gas. So he's kind of learning that things rise in price. It takes more hours of work in order to afford those things. So he has to make some adjustments to make sure he has a little more money for the things that he wants to do. It's a great lesson. And I'm proud of him. He doesn't even realize he's learning these things, but he is. So very important. And things, if you have kids or if you're in this position and you ever want to talk to me about some of these things, I've been pounding my 22-year-old son who just graduated from college. We're very excited for him. Got a job, a good job in Indianapolis, kind of where he went to college, where he's got some buddies, and his girlfriend looks like she's going to go to med school in that area. So he's in a good place in his life. But I just pounded to him that every time he gets a paycheck, man, pay yourself first. Make sure that you take X amount out of that paycheck. You don't need all that money. Take it out and invest it long term. Now, again, he's investing in some risky ventures. He's into cryptocurrency, which, again, hey, I'm all for it. He's young. He can afford to take some risk, but he's also investing in some other more stabilized things, some longer term items. I said, just be very disciplined every paycheck to take that money out. And hey, by the time you're 30, you'll be in very, very good shape. And you won't even miss it. You won't even miss the money. Just live with, below those means. Because again, as a young kid with a good salary, he's got a lot of extra cash. He doesn't have a tremendous amount of expenses. He doesn't have a house payment. He doesn't have children. He doesn't have, he's fortunate not to have student debt. So he has some advantages here. Take those advantages and take some of that capital and invest it long term. Forget about it. Spread it out among different assets and forget about it. Hopefully, I convince him one day to buy a little bit of real estate. I think he will. I think he's seen how that's worked for myself and his mom, and buy some of that real estate long term. I don't think he is that interested in the real estate investment business as I've been, is to make his income, but I think he's interested in investing in real estate longer term. So those are some of the things that you can take away here tonight. Man, I'm happy that I spent a little bit of time in May to just kind of throw some of these out. I hope some of this has kind of hit home. Let me know if you have any questions. By the way, just so you know, I do these targeted mentoring. And these targeted mentoring are 3 1-hour sessions. We can do them this way. I prefer, as we open up, that we can do them in person. You pick the subject. They've been very effective for people because we're really honing in on areas that people need work with. I had a call the other day of someone that needed help with private capital. I've had people ask me about notes. I've had people talking to me about generating leads in a very challenging environment. I mean, finding good deals is not easy. It's always been difficult. But if you know what you're looking for in the profile, geographical area, and the profile of the person, and the marketing techniques to get those calls coming in, you can make a very good living, either wholesaling or renovating or buying your first rental house. So if there's a particular subject you want to hone in on, this target mentoring is work. It's cost effective, and we really hone in on that. And I make sure that by the time we're done, you have a good understanding how you can go out in that field and apply these lessons. Again, I'm just going to throw out my number. I don't have the ability to put it on the screen. I don't have my technical help this month, but a lot of you know my cell phone is 301-943-5535, 301-943-5535. Just text that. Just put target mentoring or put the subjects you're interested in. I'll get in touch with you. We'll set up some time, and we'll do a good job with that. Jim, a friend had a property. A friend had a property in DC. Is about $300,000 for equity in the property, so he's got a lot of equity. He does cash flow, though not great. After the note expense, it is better to sell, take the equity, invest in small multi-unit family properties in smaller markets, or keep the property and continue as is. Very good question. Very common question in this area. A lot of real estate investors, landlords, we have high equity, but we have low cash flow. And that is because our cash flow to our expense of housing is not the 1% rule. In other words, I'm sure many of you heard, if you have a $100,000 house, you should get $1,000 rent. Well, if you have an $800,000 house in Petworth, are you getting $8,000 worth of rent? No, most likely not. So the question is, do you take that equity and spread that equity to a smaller multi-unit family portfolio in maybe a smaller market to increase the cash flow? All these questions are good questions. They're good problems. They're rich people's problems, which is good. It depends where he is in his investment career, Jim. It depends what he's trying to accomplish. If he's trying to create long-term retirement income or cash flow, certainly you can increase that cash flow by taking that out, doing a starker exchange, finding a multi-unit property somewhere with better cash flow. I promise you he'll have it. Jim is also an investor, and I don't think he minds me sharing that he's been investing in some other parts outside of the Washington, D.C. area to generate more cash flow. The one downside is that DC does do very well. DC metro area does do very well in long-term appreciation. Our assets grow here. In an inflationary period, they will keep up with inflation, and they'll probably outpace inflation a little bit. So it depends on his situation. It depends on whether or not he wants that extra cash flow. Most people do. So it might be a good time to exit. It might be a good time to, properties are selling. He could probably get a good value for that property. Take that money, then go to a smaller market. And really search for maybe a 4-unit building or a 6-unit building or something that will generate more cash flow. He also has to obviously factor in being further away from the property. If he lives locally, he might have to get a property manager. So he really should run all those numbers. But overall, expanding your portfolio, increasing your cash flow is kind of the name of the game. And again, some of it depends. Some of it depends where he is in his life. Is he, where is he? I mean, what's his goal? So all this starts with, what are your goals? Where are you? What do you want to accomplish? And how much risk you want to take? Because owning more units can be a little more risky than just hanging on something that is comfortable. But I would say overall, he's probably smart to do that now and to take that capital and reinvest it in a smaller market. He might not get as much appreciation, but he'll really increase his cash flow. Then again, he can use that cash flow to reinvest in other things. Remember, just because you get cash flow from real estate doesn't mean you have to buy more real estate. You can diversify. You can buy, some growth stocks. You can buy some index funds. Warren Buffett is famous for saying, don't try to figure any of this out. Just invest in low-cost index funds. Let them do the work. And over time, you're going to be very happy. Historically, he's been right. Or maybe you buy some commodities, or maybe you take a portion of that money and high fly it with cryptocurrency, or maybe you go and you maybe one of your goals is to see 10 countries before you die, and you go and take a around the world trip. Again, if you do this correctly, and as I said before, guns and butter, your guns are going to produce enough cash and enough assets and enough growth and net worth that at some point, and not too far in the distant future, don't think you're going to have to be 80, 85, 90 to enjoy this. You're going to have assets and net worth and income that you now can use to enjoy your life as much as anyone will ever enjoy their life. So that is kind of the point, and that's kind of the goal of investing in things that appreciate and spit off cash flow and net worth. So Jim, hopefully, and again, if he ever wants to talk to me, feel free. So Target Mentoring, 301-943-5535. Next month, June, we'll probably go back to maybe a little bit more bread and butter. If you ever have suggestions for any of these talks in Washington REIA, certainly let me know. Text me, email me. We'd be happy to tackle those subjects. I hope one day, I think we're getting closer to that day, we'll all be able to get back together, and we'll be able to see each other, and we'll be able to share our war stories and share our contacts and our networks and everything else that kind of comes with meeting in person. Hope that day is not too far in the distant future. Thanks so much for joining us tonight. Again, if you ever have any questions, feel free to reach out. I hope this gave you a little insight into inflation. I hope you understand that it's something that you just got to follow. You just got to track. The experts are going to have a lot of different opinions. My personal opinion, I'll end on this. My personal opinion is a lot of this is most likely a supply chain issue in my estimation, meaning we're coming out of this pandemic. We're all coming out of our cocoons in our houses, and the demand for goods and services increased. And because of the supply chain and because of some of the things that happened and the destruction of the economy on a lot of levels, it's just that demand is outpacing that supply. And once those things kind of come in balance, we'll have a more sustained inflation rate of roughly 2%, which the Federal Reserve says is fine and will be okay. That's my guess, and it's purely a guess, but I'm paying attention to it, and I'm making sure that my investments right now will allow me to survive a period of high inflation. So thanks again for joining me, folks. Anytime I can help you, boy, I miss seeing a lot of you guys. Reach out. Love to just chat with you, talk with you about anything. Doesn't even have to be about real estate, just about your family and how everyone is doing. It's great to be with you once a month, but certainly hope we can get back together soon. So take care. Thank you for joining me, and we'll talk to you soon.